Hi, welcome to the Japan Stock Data Tracker. We've had an absolutely staggering week of news to process. If you've been watching the boards, well, you know exactly what I'm talking about. We're seeing record highs wiped out, sending literal shockwaves through digital and traditional assets alike. We are looking at a masterclass in how rapidly macroeconomic stability can just completely unravel. In today's explainer, we're going totally in-depth on the data and the geopolitical events that have absolutely upended the market's trajectory in just a matter of days.
Today's explainer covers three areas. 1. Resumption of the U.S.-Iran conflict. 2. Market turbulence and crypto drops. And 3. Future market forecast. Let's get right into it.
Section 1. Resumption of U.S.-Iran conflict, a rapid breakdown of peace.
Okay, we really have to contrast the heavy optimism we saw mid-month against the stark reality of late June's sudden conflict. Think back just a little bit. The U.S. and Iran were approaching a historic peace deal in Switzerland, and the market was actively pricing in a major de-escalation. We had reports that President Trump was preparing to sign an agreement, and because of that, oil futures were dropping to multi-month lows under the confident assumption that the Strait of Hormuz would remain open and secure for global shipping. But fast forward to the end of the month, that optimism has completely evaporated. It's been replaced by airstrikes and hard blockades. The economic implications of losing that peace deal, that's exactly what we're seeing violently priced in right now.
So how did it happen so fast? The macro trigger played out incredibly quickly. After peace talks stalled over Lebanon's ceasefire disputes, Iran actually blocked the Strait of Hormuz on June 21st, which prompted immediate U.S. military intervention. What our sources tell us is that Iran declared the strait closed and prohibited vessel navigation, citing violations of the ceasefire framework by Israel and Lebanon. Now, the U.S. initially denied the closure, saying ships were still passing, but the situation on the ground escalated way faster than diplomatic channels could handle. We are talking about markets having less than a week to reprice global shipping risks from essentially zero right back up to a critical code red threat level.
And the scale of this military escalation is what truly spooked the markets. It wasn't localized. U.S. Central Command initiated targeted strikes after a Panama-flagged tanker was hit by a suicide drone near the Strait of Hormuz. In a rapid response, Iran's Revolutionary Guard didn't just fire back at U.S. assets. They widened the geographic net of the conflict entirely. They fired drones and missiles at neighboring nations like Kuwait and Bahrain. You see, this geographic expansion is absolutely terrifying for the energy sector, because targeting Kuwait and Bahrain threatens the broader Persian Gulf infrastructure, not just the single choke point of the strait.
Which brings us to President Trump's stark warning. The time may come when we can no longer remain rational. This quote really underscores the severity of the situation. It forcefully shifted global markets from an expectation of peace straight into pricing in full-scale warfare. He specifically referenced violations of the ceasefire agreement, warning that the U.S. might be pushed past its point of restraint. And look, when the leader of the world's largest economy uses this kind of rhetoric regarding the Middle East, algorithmic trading systems and institutional managers, they do not wait around to see what happens next. They parse this language and instantly trigger massive risk-off sell orders.
Section 2. Market turbulence and crypto drops. Investors flee risk-on assets.
So, with cargo ships being attacked and the Strait of Hormuz locked down, we have to ask, how exactly is the broader market reacting to this sudden panic? Well, historically, when the Middle East destabilizes, capital flees from risk-on assets and rushes towards safe havens like gold or U.S. Treasuries. And, right now, we are witnessing a textbook execution of that capital rotation. Traders are aggressively dumping their most volatile holdings to secure cash and safety.
This investor panic was perfectly anchored by Bitcoin plunging from over $64,000 down to the $60,000 range, or about 9.7 million yen. Because Bitcoin trades 24/7, it acts as the ultimate canary in the coal mine for geopolitical shocks that happen over the weekend, when traditional equities are closed. Just days prior, digital assets were holding strong levels, but the moment the news of the airstrikes hit the wire, weekend traders aggressively dumped to secure liquidity before the traditional markets even had a chance to open.
It's a sea of red across all major digital currencies. It's not just Bitcoin taking a hit here. Ethereum slid down to the 255,000 yen mark, and XRP is down to 170 yen. This isn't a targeted sell-off based on crypto fundamentals. This is a broad, systemic de-risking event. Once Bitcoin breached its key support levels due to the geopolitical news, algorithmic trading just accelerated the drop, dragging the entire altcoin market down with it in a massive cascade of liquidations.
And the impact on the Japanese market has been just as violent. The Nikkei 225 averages have violently fluctuated, dropping from the 71,000 range down below the 70,000 mark in recent futures trading. Remember, we were looking at a market that had just recently pushed past record highs, sitting comfortably at 71,850. But as Sunday futures opened and the harsh reality of the Middle East conflict set in, we saw a brutal wipeout. The index tumbled all the way down to 69,610. The psychological blow of losing that 70,000 support level so suddenly has left the market incredibly fragile.
The direct fallout is crystal clear. WTI crude immediately jumped back up, adding over 1% just on the initial news of the blocked straits. Meanwhile, high-flying tech names and semiconductor indexes are facing intense downward pressure. Why? Well, when energy prices threaten to spike, the market immediately recalculates the cost of manufacturing. Japan is a heavy importer of energy, so when oil spikes, the cost of running massive semiconductor fab plants eats directly into corporate margins. Investors know this, which is exactly why the semiconductor stocks are bleeding. They're bracing for supply chain and margin disruptions.
Section 3. Future Market Forecast. Navigating the Storm.
A massive headwind for the Japanese market is this historic number right here. The yen has collapsed to 161 to the dollar. That marks a 40-year low. And we have to connect this directly back to the geopolitical crisis. Because Japan relies heavily on Middle Eastern oil, the conflict threatens to dramatically widen Japan's trade deficit. Importing more expensive energy crushes the currency. It places catastrophic downward pressure on the yen and drives it to that 161 mark, a level we haven't seen since 1986. Now the market is practically holding its breath, just waiting to see if the Bank of Japan will intervene. Compounding the incredibly weak yen is the hawkish outlook from the U.S. Federal Reserve. Let's trace how this builds. Previously, the market was really hoping for rate cuts, but the Fed is now being forced into a hawkish stance entirely because the U.S.-Iran conflict is threatening a massive spike in global energy prices, which would reignite U.S. inflation. Right now, there's a 60% probability that rates hold steady in July, but the real pain point is the growing expectation of a rate hike in September. And incredibly, there's even the possibility of a second hike by the end of the year, just to combat that energy-driven inflation.
So this rising oil price from the Middle East conflict fueling inflation, it's the ultimate macroeconomic trap for risk assets right now. Investors are caught between a rock and a hard place. The rock is the geopolitical supply chain shock out of the Strait of Hormuz. The hard place is that central banks are unable to offer a safety net via interest rate cuts because those energy prices are keeping inflation sticky. This severely complicates central bank strategies, and traditionally that crushes equity markets in the process.
Considering the massive macroeconomic pressures and the resumption of war, we want to leave you with this final critical question. Will the semiconductor market survive tomorrow's trading session? With high interest rates looming, a historically weak yen driven by energy imports, and the Middle East conflict threatening to sever critical global supply chains, the tech sector is facing its ultimate stress test. The coming days will determine if this is just a temporary dip or the beginning of a prolonged, conflict-driven bear market. Keep a very close eye on the boards. Thank you for joining this explainer, and stay vigilant out there.